Today, Bitcoin falls to $57,000 and crypto-related stocks stumble to kick off September trading. A group of crypto executives are planning to host a DC fundraiser for Kamala Harris next week, and the cybercrimes research lead at Chainalysis discusses the firm's latest mid-year crime update, which shows that a certain type of crypto romance scam is proving to be highly lucrative. Crypto prices are in the red post-Labor Day, with Bitcoin falling to the $57,000 level as of noon Eastern. Ether also fell, dropping nearly 3% to $24.43, and Cardano's ADA token was in the red as well, even after the blockchain's upgrade went live on Sunday. Cardano's Chang hard fork marked the ecosystem's long-planned shift toward decentralized governance. Now taking a look at crypto-focused stocks on the first trading day of the month, as of midday, all are down, with Bitcoin miner CleanSpark falling the most, more than 13.5% to be exact. The move lower came just hours after CleanSpark released its mining update for August, which revealed that the company mined 478 Bitcoin last month, marking a drop from 494 the month before and 659 last August. Okay, let's talk about the top stories. As digital assets take on more of a role in this election cycle, a group of crypto executives and Web3 builders are holding a DC fundraiser for Democratic presidential nominee Kamala Harris. Now, according to one of the organizers of the event, scheduled for next Friday, the group aims to raise at least $100,000 for her campaign. Cleve Mesidor, the founder of the National Network of Women of Color in Blockchain, who is co-organizing the fundraiser, confirmed to us that the event would also be used as a platform to call on Harris to be softer on crypto regulation, with the goal of advancing a policy and framework for DeFi and Web3 that fosters innovation in the U.S. Meanwhile, Republican candidate Donald Trump has been positioning himself as a pro-crypto candidate, sharing last week on X that he wants to ensure that the U.S. will be the, quote, crypto capital of the planet. Now, Trump was the keynote speaker at Bitcoin 2024 in Nashville in July, and his campaign started collecting crypto donations in May, attracting the backing of big names in the industry, including the Winklevoss twins. Next, the SEC could be poised to throw a curveball into FTX's bankruptcy repayment plan. A Friday filing from the SEC mentions that the exchange's estate is considering distributing stablecoins to its creditors. The regulator points to a filing from last month that defines cash to include U.S.-backed stablecoins. The agency didn't give guidance on the legality of this plan, but said that it reserves the right to challenge transactions involving crypto assets, meaning the agency could object to the plan later on if it saw fit. The industry has made countless calls for clarity on which tokens fall under the SEC's jurisdiction, though no official classification has been made for U.S.-backed stablecoins. In April, Republican Senator Cynthia Lummis of Wyoming and Democratic Senator Kirsten Gillibrand of New York put forward a bill that aimed to create a regulatory framework for stablecoins. Last, Coinbase reported its first AI crypto transaction as the integration of the two much-hyped technologies heats up. In an article shared on X on Friday, Coinbase CEO Brian Armstrong announced that the platform's first AI-to-AI crypto transaction took place last week, calling the development an important step to AI's getting useful work done. Armstrong noted that while AI agents cannot get bank accounts, they can get crypto wallets and can now use USDC on the Ethereum L2 blockchain network developed by Coinbase, called Base, to transact with humans, merchants, and other AI agents. He pointed out that currently, AI agents face limitations in completing tasks independently because of the lack of access to traditional financial tools like credit cards or payment methods for services like AWS or GitHub. However, Armstrong suggests that this new capability could allow AI to overcome these limitations. All right, for our main story, Chainalysis recently released the second part of its mid-year crime update, showing that pig butchering scams remain lucrative. In fact, the blockchain analysis firm says that it is the largest revenue-generating scam type so far this year. I caught up with Eric Jardine, the firm's cybercrimes research lead, to discuss the key findings of the report and what actions are being taken to prevent the trend from escalating further. Okay, so first things first, let's talk about the top line numbers here. Illicit activity is down 20% year to date. Talk about this trend and how it fits into the comeback in crypto from the lows of 2023.
Absolutely. I think the important piece of context is that legitimate activity is near to record highs, being beaten out only by the peak of the last bull market cycle. And so that puts into context this year-over-year drawdown that we're seeing with illicit activity, as you said, about 20% down year-over-year, year-to-date. And I think it's important to note in that broad context of things that this is the second year in a row that we've seen a year-over-year decline of this sort, and that this year, just like last year, there are sub-trends, illicit activity categories that are bucking the overall macro pattern and are up year-to-date in quite a worrisome fashion.
Now, of the areas that are seeing illicit activity, this report says that it's ransomware and stolen funds. Pig butchering specifically is the largest revenue-generating scam. What makes this type of scam so effective? And is there something about crypto that makes it appealing for pig butchering scams in particular?
So I think of the trend toward pig butchering in terms of risk-adjusted return on the part of the scammers, that the Ponzi schemes of old that we used to see in crypto quite frequently, those could be very large revenue generators, but they were also very easy to identify and track on-chain and off-chain. And what we're seeing now with scammers is an adaptation of tactics towards pig butchering, which targets individuals as individuals, often leveraging relationships struck up on social media or via text message. So you might get a smaller per person payout through this method, but it's a lot harder to track because you're able to adapt your on-chain and off-chain infrastructure a lot quicker. So in risk-adjusted terms, scammers have moved in this direction because they're able to get away with off-ramping funds and seizing funds from unsuspecting victims.
So one thing you point out in the report is that many of the year-to-date scam inflows are going to new wallets. Now, does this suggest that these are new scammers to the space, or just that more and more of the scammers that are out there are turning to crypto rather than other payment methods? And what do you make of that?
So I think about it in terms of adaptation of on-chain infrastructure, that they're basically able to generate new wallet infrastructure probably almost every time. We see a fairly sizable decline in the average duration of scammer infrastructure on chain, down to about 44 days so far in 2024. And all this says to me that scammers are basically recognizing that persistent on-chain infrastructure is a vulnerability to their operations. You can pinpoint it, you can trace it, and therefore you could do things like fund restitution if you're following funds flowing out of these wallets, or you can try to trace it back to actually identify the real-world identity of the scammers themselves. And so these scam operations have basically moved towards greater adaptation, more frequent infrastructure turnover. And this is something we see on-chain as well as off-chain in terms of purchasing new social media infrastructure, for example, in order to bait victims.
Do you expect this trend of pig butchering scams to increase through the rest of 2024? And do you feel like the public and law enforcement are properly prepared to combat this?
I think in terms of the trend, my guess at this point would be yes, that the trend that we've observed so far is likely to continue. Everything that we've seen over the last few years points in that direction. When you see, for example, the augmentation of conversations and social profiles through AI, you're probably going to see that worsening the situation even. And all that, I think, gets into your second question, which is like, is the public and is law enforcement prepared? I think we have a number of very encouraging takedowns of scammer operations and fund restitution. That's always nice to see. But generally and by and large, I think there is, as evidenced by the numbers, a pretty worrisome trend and trajectory here, suggesting that people are still being scammed daily.
And ultimately, where is the responsibility for shutting down those scams? Are the platforms or exchanges the focus on fighting back, or does it really fall on the individual?
I think the individual, the best that they can do is just be skeptical and aim for a degree of prevention, but recognize that they are the victims in this relationship. I think otherwise, it's a all hands on deck kind of scenario. Everyone would have a role to play, from law enforcement through exchanges, through token issuers, and everyone else in between.
Last question for you. Any other big trends that surprised you in this most recent report that just came out?
I think the big macro trend, as you pointed to in the beginning, is that, all the forms of predatory cybercrime, the ransomware, the stealing of funds, and the scamming of victims, those are the areas where we're seeing worrisome growth year over year. And that's, I think, a big point of concern for governments around the world.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.